Hello, my name is Charles Lincoln, and I'm going to be doing a presentation on BEPS as a sponge tax. I fixed a few slides, but I'm back in the game. United States has sought to minimize erosion of its taxable base by U.S. multinationals. This is also a goal of BEPS. Here I have a picture of the U.S. tax court. In the middle is the image of the IRS, and on the left, which the audience would be the left, would be the U.S. Department of Treasury. These are some key players, and we're going to touch a little bit on them in this presentation. But we're also going to touch on the OECD, G20, and BEPS. These are some OECD countries that are highlighted right here, and or the G20 countries are highlighted here, and they have some overlap. They're working on the BEPS project in conjunction with each other. Overall, there's some very good things that are happening with BEPS, but there's some bad things as well. And uh, one of the bad things that the article touches on initially is that the BEPS of the United States has been negotiated primarily by the Treasury. And so but what the problem is, the U.S. Department is focused primarily on stripping the U.S. tax base of U.S. multinationals, which is also a goal of BEPS, but it leads to foreign countries gaining the tax that the U.S. does not. Here's the conflict with the U.S. summed up. Internally within the U.S., the U.S. Treasury was negotiating with the OECD without congressional approval or input, I should say. And we have to remember that Congress has also the power to rewrite laws, not the Treasury. And maybe it's a good idea to have a image of Congress over here from Wikipedia. So that's that. The death and estate tax. The article discusses the death and estate tax as an analogy. Uh, oh boy. The death and estate tax is an analogy to the credit subsidy. So bear with me for a minute as the article asks us to do. And as the death and estate tax incentivized states to maximize the amount that they could tax, foreign countries will be incentivized to tax the maximum amount that the U.S. could subsidize. So, the death tax explained. Basically, the tax imposed by 2001 shall be credited with the amount of the estate inherited to the legacy or succession taxes actually paid to any state or District of Columbia, respectively, or any property included in the. Going to put another image here. So the death tax explained is basically that if you look to Section 201 of the IRC, the tax shall be credited with the amount of any estate, inheritance, legacy, or succession taxes actually paid to any state or the District of Columbia in respect to any property included in the general excise. So here's just a table of credits that you can get for amounts that you've paid, the credit that you'd get correlating to the federal income tax. So and that leads to the limit that shall not exceed the specific taxes. So that limit is important. So foreign jurisdictions, by analogy, would be incentivized to collect on the taxes that normally go to the U.S. Arguably, Apple will have to pay higher taxes the amount in China and less taxes to the U.S. And I found this from a summary of an article by Nobel Prize winner from the Huffington Post right here. So how it affects the IRS and U.S. tax credit is if foreign countries follow the OECD project, then the U.S. multinationals will pay greater taxes abroad compared to what they're paying now and claim more foreign tax credits. Thus, U.S. tax revenue could be eroded by a huge increase in foreign tax credits. So the issue being magnified, if we look into it, in the example, this is a quote from the article. Foreign government could impose a 15% rate because there would be no negative effect on the business investment by the companies. The company would face taxes on the earnings of its foreign subsidiary, a 15% rate, regardless of the taxes. So the other issues in the sponge effect is that taxing income globally has posed some challenges to the United States and more companies to employ hybrid structures to avoid tax repatriated income. In addressing stripping of the U.S. tax base, it also is important to consider the hybrid arrangements which allow U.S. taxpayers to claim deductions, respecting payments that do not result in corresponding items of foreign income, the jurisdiction. These arrangements serve little fun. There is a concern about Action Plan 2, because it could lead to the erosion of U.S. tax base. All right, we're going to Wikipedia. Get a photo somewhere. And then, all right, so continuing on, how it affects the U.S. negatively could be added. It could shift additional revenue outside the United States. The excess return proposal, subpart F, could be to become separate income for determining taxpayers' credits. It would raise foreign tax credits and penalize U.S. multinationals, thereby allowing U.S. multinationals to avoid the penalty. My counter thoughts to the discussion is that the U.S. Treasury was really negotiating arm of the executive for treaties and international organizations relating to tax. The executive agencies are not given authority to determine laws if Congress has not acted. And just to confirm that the executive branches are allowed to act as long as they're acting under the penumbra or they're acting under the guise of the Chevron doctrine, which was enumerated by the U.S. Congress, U.S. Supreme Court in 1984, and this is a summary of my summary of the Chevron doctrine. Basically, you have to ask if Congress has acted, and if the agency has acted, is the action, and if Congress, and if not, if the agency has acted, and is the action permissible within the penumbra of Congress's action. However, I would counter that counter argument by stating Congress was never informed, and there is no statutes applicable to trigger this analysis. But another counter argument is that multinationals should be paying taxes abroad for their work abroad. Support for this is from Peter. I also have support from this from Peter Harris that said in his lecture to us that often multinationals do not mind double taxation as long as it is certain that clear what the numbers will be. Overall, the author does not oppose BEPS outright and sees it as a valuable, but recognizes the need to keep the U.S. revenue coming.